We've seen the headlines talking about what's in the bill, but now that the dust has settled, what really matters for investors and the economy? Today we're going to go beyond the fine print to ask which policies will actually move markets and where are the biggest risks and opportunities. We're going to break that all down for you and a lot more right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us today. Jason Cole, who is the head of public policy from Future Standard, is my guest in the studio today. We're going to go in between the lines of the bill, talk about tariffs, talk about Jay Powell. There's a lot to get to. So, first of all, Jason, welcome to the studio. Great to have you here today.
It's wonderful to be here. Thanks, Anthony.
Yeah, and by the way, I will, as we noted before we started today, we have to always let our audience know that we're recording this on July 17th, and because things can change at a moment's notice, as I think we've all become accustomed to. So we know now the reconciliation, or the One Big Beautiful Bill as it's been dubbed, it was signed into law on July 4th. Before we get into the impact on markets and the economy, just remind us some of the key highlights of what you're really paying attention to that you thought was in the bill that was important to discuss right now, because there's a lot of items in there.
Yeah, and I think big picture, and let's focus on what's important to your advisors, your investors, your clients. Extension of current law with some slight expansion, about $3.9 trillion worth of tax relief avoided, right? No changes, no deep dives. It's just an extension of current law. Then you get into some new pieces, all of President Trump's promises on the campaign trail. No tax on tips, overtime, auto interest, Social Security, which was a little bit of a tweak. It's actually a senior deduction. Those things are term limited until 2028, which is interesting because it means taxes will be on the ballot in the next presidential election.
Right.
It's something to pay attention to. But in terms of the new tax relief in the bill, it's only about $850 billion. And so if people are looking for a new stimulative punch, that doesn't per se exist here. I mean, I think the biggest pieces in terms of new relief relate to the business provisions, things that were actually part of 2017 but expired a couple of years ago. Bonus depreciation, expensing, R&D tax credit. That's the bulk of the new relief, and that's the bulk of the piece that may actually provide some stimulative punch to get the economy growing in a more meaningful way.
Yeah. I mean, that really kind of, you talk right away, you mentioned the economy there. What do you think the fiscal impact is? Because on the flip side of this, we could see $4 trillion added to the debt based on what's in this bill. So if you look at all the variables, how does that impact the economy overall over the next 2-3 years?
Yeah, CBO scores this at $3.2 trillion. And I think it's important for your listeners to remember that it's a static score. Right? There's no dynamic effect, so they can't take into account maybe the stimulative punch that the R&D tax credit or the no bonus depreciation or the expensing has. It's a static $3.2 trillion increase to the debt over a 10-year period. Now, this is a debt that's already $36 trillion.
That's right. It's already out there.
100% or more of GDP. And I think markets may be a little complacent with regard to how much this is adding to the debt over this 10-year period, one. Two, some of the spending reductions in the bill and I think are being largely missed by market watchers, are the Medicaid pieces. And not necessarily the cuts to individuals, but there's reductions in payments to states who get federal reimbursement for their Medicaid dollars. Also on the nutrition side, all in, that's about $500 billion. That's less that's going to the states, most of whom have balanced budget amendments. And so they're necessarily going to need to deal with that at the state level, which could pull more dollars out of the economy as well. So it's something to pay attention to.
Right, absolutely. Thanks for bringing that up, because we're looking obviously at the big picture of everything. We've got not only the bill passing, but then we're still dealing with tariffs, the back and forth. By the way, just as we sit here, our chief investment office here does think, even with the maybe decline, or the increase, I should say, in U.S. borrowing because of the debt and what's in the bill, we still think fiscally that the economy has some strength. So it's not like we're looking at the bottom's about to drop. CIO still thinks that there's some security there with the economy here in the U.S.
I think that's probably accurate. And I think again, the fact that CBO isn't dynamically scoring this bill is something to pay attention to,
Right.
and to see how those interactions occur over the next decade. When we see certainly some growth from the new business provisions, I think that's what I'd be paying attention to.
Yeah.
So I tend to agree with your CIO.
Great, thanks, Jason.
Yeah.
Interestingly, when you kind of look at, there's the economic growth in general, do you think that the policies that are inside of the bill could fuel a boom based on what we've seen?
Again, I mean, this is why I want to underscore the point. When you're talking about tax increases avoided, I'm not sure that's boom inducing.
Okay.
Right? It's status quo continuing on ad infinitum or until Congress steps in again.
Right.
Other than the new provisions. And again, that's only about $850 billion. I think the business pieces are things to pay attention to. The individual side, tips, overtime, and whatnot, A, they're temporary, and B, there's not a lot of dollars there. There's a number of restrictions around, particularly the tips and overtime provisions, that may mitigate their real fiscal impact.
Great. Thank you, Jason. I want to switch gears a little bit because back to tariffs for a second. There are varying tariffs that the administration has been going back and forth on. As we sat here today, it looks like they're trying to prepare for potentially retaliatory steps from the European Union, according to a lot of media reports. India, there may be some kind of a deal they're working out there. I will just caveat all this and say that we think here at UBS and the CIO that we're going to see probably across the board roughly a 15% nominal rate for tariffs without, taking all the posturing out and all the back and forth. But there are concerns about these tariffs in general and the inflationary kind of impact of tariffs, and you're already starting to see that. We had CPI, the consumer price index, come in a little bit higher month over month, and that, according to what we're seeing from economists, is related to. But the interesting thing is, on the labor side, they're not laying off people yet across the board, although we're starting to see some signs of some weakening because private payrolls are maybe less than where they were in the last couple of job reports. So things like that are starting to creep in. Mm-hmm. What's your view on all of that when you think about tariffs and inflation?
There's a lot to unpack there.
Yeah.
Look, tariffs, in my view, are a tax increase. And we're on target to raise on the order of around $300 billion in revenue through tariffs. But that's a tax increase. If you think of it in terms of what that would translate to in terms of an individual rate, it'd be about a % rate increase on individuals. And so the tariff revenue almost offsets what you're receiving in fiscal benefit from the one big beautiful bill, which is interesting when you begin unpacking that. More to the point, however, is the notion, and you hinted at this, that the Europeans, for example, are looking at retaliatory, right? And to the degree that countries begin retaliating against the United States, that could have even a greater fiscal impact in terms of ratcheting inflation up as
Right.
we see prices on goods and services move up. The Census Department does a biweekly, every 2 weeks, survey of manufacturers. And since January, you've seen this steady uptick in manufacturers just say, yes, my input costs have increased. But interestingly, you've seen a relatively stable line of manufacturers saying, no, I'm not passing them along yet. The question is, and we got a little early evidence on Tuesday from the CPI print, that perhaps inflation may be ticking up and those costs may be passed along. Something I think very much to pay attention to in the next 3 months.
Yeah, and clearly, as his name keeps coming up in the news this week, Jay Powell, who's the head of the Federal Reserve, really has quite a job ahead of him, as well as the rest of the FOMC. Meanwhile, as we were sitting here just yesterday, there were some reports from inside the White House that the president was looking to fire Jay Powell, and then the markets actually reacted versus the general complacency we've seen recently. There was a pretty quick snap reaction, a decline in the S&P about 1%, and the dollar, Treasury yields rose, and then quickly the president came on TV and said, no, we're not doing it. Maybe it's on the table, but it's not happening yet, and then the market reacted.
And a quick snapback, yeah.
That's right.
Exactly.
All in a matter of 35 or 40 minutes.
Exactly.
So do you, just going to Jay Powell for a second, what do you think he's going to need to do, given that we are going to assume he's going to be in the chair?
I assume he's going to be in the chair.
Yeah.
I don't think he's going to be fired, but he's only in the chair until May.
Right.
Right. His term as chairman expires in May of 2026. And so we're talking about 7-8 months,
Right.
maybe a little longer from now. I think the other important thing to remember is the Fed chair does not on his or her own set rates. It's the 12-member Open Markets Committee that sets rates. And so one has to wonder that even if a Jay Powell is replaced before now in May, or even at May and beyond, does anything in the rate environment change, or do they continue to look at the data and preserve their independence? And if the latter is true, that they look at the data and tariffs, for example, show inflation ticking up, then they may be loath to raise rates.
Yeah.
I'm a little contrarian from the market. The market's got baked in 2 rate cuts this year. I'm not sure that's going to happen.
So Jason, obviously there's a lot that's going on and there's a lot in the bill itself. If you were going to take it from, say, a policy perspective, what's next for the U.S., given what we now know from the bill and all the other things that are happening?
No, terrific question. First, almost the entirety of what President Trump ran on was in the one big, beautiful bill. I think broadly, particularly in the financial services space, which I track most of the time, we're going to begin seeing some deregulation. The president now has his regulators in place, particularly at the SEC, and I think we're going to begin seeing some things in that area, not only out of the agencies, but on Capitol Hill. And you're going to see a lot of things coming out of the SEC, I think, to enhance and make it easier for investors to get into things like private markets, private credit, private equity, real estate. And so those are things I would look out for the remainder of this year and into next year.
Great, Jason, thank you very much. And as we keep saying, there's still a lot of uncertainty that still exists, especially around tariffs and the direction of the economy. So we'll really be continuing this conversation. I hope we get to do it with you sometime soon. Come back and visit us.
I'd love to come back. Thanks, Anthony.
Thanks again.
Appreciate it.
Jason Cole, Head of Public Policy at Future Standard. And for more information on everything that Jason and I were talking about today from Future Standard and, of course, our Chief Investment Office, visit our website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn, Facebook, as well as Instagram. Check us out at UBS Trending. Lots of studios content there for you. And as always, if you'd like to continue this conversation, make sure that you're doing so with your financial advisor. Until next time, I'm Anthony Pastori. We wish you a great rest of your day, everybody. And remember to keep your eyes on what's trending. See you soon.